Hi, John. Good to be with you. We think that inflation continues to be a real challenge. I think the inflation data points that came through over the course of the last, couple of weeks suggest that while inflation's coming down at a pace that is important for the long term, it still is proving to be a bit stubborn. And our own work that our teams have done suggests that inflation is going to be at a higher level exiting 2023 than the market's assuming right now. Our expectation is that you're going to be more in the 3.5% range for inflation. I think that's one of the reasons why the Fed minutes and the commentary from the Fed is consistent with our view that the Fed's going to be higher for longer because inflation is proving to be a bit more stubborn.
So how should investors adjust given that and considering the big move down we saw in the market yesterday? Are you kind of buying dips? Are you looking at a particular sort of value to get into?
We certainly think that the market's going to remain quite volatile here over the course of the next couple of quarters as they continue to recalibrate, whether it's the earnings picture or whether it's the rate path and policy rates for the Fed or monitoring where inflation is. So, I think it pays to be cautious here. We have been underweight equities for a while. We've remained in that view. That doesn't mean that you're zero weight equities. We think there are opportunities. And certainly as things dip into correction territories, then it pays to add a bit more risk. And as they get a little ahead of themselves, as maybe, we saw a couple of weeks ago, you take a little bit of money off the table to be a bit more careful.
So, Joe, the last time you and I spoke, which was the end of last month, you were cautious on equities then, too. And I asked you this question, and I'm going to return to it. And that is, what is the data that's going to turn your opinion and make you a little more bullish here?
Well, I think it's a combination of the Fed and where inflation is, and then thirdly, earnings. I think those three things remain the most important elements. Right now, the economy is proving to be more durable and more resilient than many have expected. Right. So that's going to lead the Fed to be that much more strenuous, if you will, in keeping rates at a higher level. We think that earnings need to come down. We think they're starting to come down. Fourth quarter earnings were generally in line, but if you exclude the strong energy sector, earnings were actually down mid to high single digits in the fourth quarter of last year. So, we think there's more adjustments to be had. So as you start to see earnings recalibrate, that I think will put pressure on equities, but then that also creates an opportunity to add risk. And that's going to be likely coincident with the Fed pausing on its rate hikes.